Welcome to Chapter 3 in accounting, and we are going to focus on adjusting accounts this chapter. This will basically take the concepts that we learned in the last chapter in terms of financial statement preparation and kind of kick those up a notch. But before we do that, we're going to talk about a couple of key concepts. The first is that when we are talking about financial statement preparation, we are talking about an accounting period. We're not preparing financial statements since the day our company opened. We're looking at focusing on what occurred within a window of time. Now that window could be a month, a quarter, a year, it could be half a year, whatever makes sense for the company. And generally they're prepared on an annual basis, but often companies will also have interim financial statements prepared at these non-annual, monthly, quarterly, or whatever dates. When we record transactions, they are either recorded under a cash basis or an accrual basis. GAAP accounting is premised on accrual basis. You will likely run into companies that keep their books on a cash basis, but that is not GAAP. And let's talk about what the difference is between accrual and cash. An accrual basis, if I sell you something and you don't pay me until next week, I'm still going to record the sale, and I'm going to record the fact that I now have an accounts receivable from you for that sale. I haven't received any money yet, but I'm still accounting for the sale. On the other hand, on the cash basis, if I sell you something and you don't pay me till next week, I don't record the sale or the fact that you owe me for this until you actually pay me. So from a sort of a purist standpoint, accrual accounting gives greater transparency into the financial circumstances, because with cash basis, you could have things going on that never actually show up in the financial statements until money changes hands. So not only do we want to be able to give our financial statement users accurate insight into what's going on in the company, but we also want to adhere to what's called the matching principle, which is that we record revenue and expenses associated with that revenue in the same accounting period. So, for example, if I generate a whole bunch of expenses and record revenue on a cash basis. If I've got a cash basis business, a store, a retail store, for example, and money is changing hands all day long, and I've got all this revenue, but I don't decide to pay my bills until January of next year. Now I've got revenue in one accounting period and the expenses in another accounting period. So it might look like I have high income in one period and maybe a loss due to all these expenses in the next accounting period. So we don't want that to happen. We want to attach the revenue with the expenses that were necessary to generate that revenue. And just a brief example here. I'm going to try and kind of move myself out of the way. So on December 1st, we've got the Fast Forward company. They paid cash for a 24-month insurance policy for the business. Now, on the cash basis, we're going to record an insurance expense right off the bat. And then, because this is for 2 years, we would have no insurance expense on the books for next year or the year after, because it would all be recorded at the moment that we take it. Now, we still used that insurance in the time periods going forward, and we want to be able to match the expense for that insurance we had to pay with that later revenue that was generated during those periods. So we recognize revenue in the accounting period that we earned it, whether or not we were actually paid for it under an accrual basis. Similarly, we recognize expenses during the time period that we actually incurred the cost, whether or not we actually paid for it during that time period. And so it is really these concepts sometimes that, well, not sometimes, but that require adjustments to be made. And the adjustments really come in 4 types. We've got deferral of expenses, deferral of revenue, accrual of expenses, and accrual of revenue. And I could sort of talk about this 3-step process here, but I've decided that we're really better off to hop on to the next video where I will talk specifically about adjusting entries for deferral of expenses.